Right, so let's say you want to get started with this investing thing. You might have a bit of money saved. It's probably not enough for a house, but you reckon I should probably invest this in something. Maybe you've heard on the news about Tesla or Netflix or Amazon and how if you'd invested 10 years ago in Tesla, then you'd be a millionaire by now or things like that. But if you're new to the game, this whole investment thing can seem like a really complicated black box. Like, how do you even buy a stock? What even is a stock? Do you just go on Tesla.com and buy some Tesla? Like, how does it work? And if you try and look into this, you get all these acronyms being thrown around like Roth IRAs and 401ks in America, or like ISAs and LISAs in the UK. And on top of that, there is the anxiety that we all have that I know investing is risky and I don't want to lose all of my money. So in light of all of that, this is the ultimate guide on how to get started with investing. It is the video I wish I would have had 5 years ago when I first started investing in stocks and shares. And we're going to cover this by thinking about investing in 10 different bite-sized steps. So the first one is forgetting about investing completely and just thinking, what happens to my money over time by default? And if you've studied economics, you will know that your money loses its value over time thanks to something called inflation. Inflation is generally around about the 2%, 2.5% mark. And so that means that every year stuff costs about 2% more than it did the year before. For example, in 1970 in America, a cup of coffee cost 25 cents. But in 2019, that same cup of coffee cost $1.59. That is inflation in action. And so let's say you've got £1,000 in your hand right now, and for the next 10 years, you just stash it under your mattress and you never look at it again. In 10 years time, your £1,000 is not going to be worth £1,000 anymore because everything will have increased by 2%-ish every year. So the value of your money will have fallen. And so if you put your £1,000 under your mattress for 10 years, you will lose money over time. And this is obviously not good. Even if you put your money in a savings account, like these days, a savings account will give you like 0.2% interest, which means your money goes up by 0.2% every year. But because inflation is up by 2%, you're still losing money over time. And again, this is not good. Okay, so that begs the question, which is key point number 2, which is how do we stop our money from losing value over time? And the answer is that if we had a hypothetical savings account, one that was, let's say, an interest rate of 2.5%, that would match roughly the rate of inflation. So inflation means everything goes up by 2.5% in terms of price, but our money in our savings account also goes up by 2.5% each year. Therefore, we're technically not losing money over time. If you're watching this and you have an issue with the word interest, then don't worry, stick to it for now. Investment is not the same as interest, but we'll come back to that a bit later. But the point here is that we don't just want to not lose money, which is what happens at our 2.5% rate. We actually want to make money. And that brings us on to question number 3, which is, well, how do we actually make money? Now, let's go back to our hypothetical savings account. If, hypothetically, we could have a savings account that was giving us a 10% interest rate, this would never happen because that's just way too high. But hypothetically, if it did, that means that every year we'd be making 10% of the value of the money in our savings account. So for example, if I were to put £100 in a savings account right now, then next year it would be worth 110. And then the year after it'll be 121 because it's 10% of then the 110. And then it would be 130 something. And this would very quickly compound so that in 10 years time, my £100 will have become £259. And if we adjust for inflation, then our money is still worth £206 in 10 years time. This is pretty good. We have more than doubled our money by just putting it in this hypothetical 10% interest savings account. And it really doesn't seem like it would do that because 10% feels like a small amount of money. But if you extrapolate 10% over 10 years, you actually double your money, which is pretty awesome. Sadly, these hypothetical 10% saving accounts don't really exist because it's just way too high and real life is not that nice. These days, most savings accounts in the UK, and I imagine around the rest of the world as well, offer less than a 1% savings rate, which means you're actually still losing money over time. But we do have other options to try and get us to this magical nirvana of like, you know, this 10% saving thingy. And that is where investments come in. So point number 4 is, what is an investment? And the answer is that an investment is something that puts money in your pocket. For example, let's say you buy a house for £100,000 and you want to rent it out to people. There are 2 ways that's an investment. There are 2 ways you're making money from it. Firstly, let's say you're charging some rent to the people living in your house. Let's say you're charging them £830 a month. That becomes £10,000 a year. And so every year you are making £10,000 in rental income, which is 10% of what you originally paid for the house. That means that in 10 years time, you'll have paid off the £100,000 that you put in because you're making 10K a year. And beyond that, every year, you're just making £10,000 in pure profit. So that's pretty good. But secondly, it's an investment because the value of the house itself would probably rise over time. In general, there is a trend in most developed countries that house prices tend to rise over the long term. And so your house will probably be worth more than £100,000 in 10 years time. And in fact, in the UK historically, in the past, some people have said that house prices have doubled every 10 years. So maybe your house is worth close to £200,000. And so you've made money off of the rental income, but you've also made money off of the capital gains which is what we call it when an asset increases in value over time. But the problem is that buying a house is a little bit annoying. You need to have quite a large amount of money for a deposit. You need to get a mortgage. You need to actually have the house. You need to sort out the rental management, rent it out to people, all of that kind of stuff. If only there were a way of investing without A, having a large amount of money to start with, and B, without having to put that much effort into managing the asset as well. And that brings us on to investing in shares. And for me, basically 100% of my investment portfolio is entirely shares. I have a tiny percentage in Bitcoin and I own this house, but I don't consider this house an investment. I'll talk about that in a different video. Therefore, point number 5 is what are shares and how do they work? So buying shares is probably as close as we're ever gonna get to this magical savings account that just returns some amount of money each year. And the idea is that when you buy a share, you are buying a part ownership of the company that you've got the share in. For example, let's say that Apple have a particularly profitable year because lots of people have bought iPads as per my recommendations, and because Apple are feeling kind, they are choosing to pay out a dividend to their shareholders. So for example, they might say that they're going to issue a dividend of £1 million, and that's going to be split evenly amongst whoever owns shares in Apple based on how many shares they own. So for example, if you happen to own 1% of Apple, you would get 1% of that dividend that they've issued. So 1% of £1 million, which is £10,000. Obviously, no one watching this actually owns 1% of Apple unless Tim Cook you're watching. I don't even know if you own that much because that would make you an extremely rich person because Apple is a very valuable company. But that's basically how the dividend thing works. A company decides to issue a dividend as a way of returning some of its profit back to the people who have invested in the company, and therefore you make money through dividends. The second way of making money from shares is sort of like with houses in that you get the capital gains over time. So for example, let's say you bought 10 shares in Apple in 2010. At the time, those shares were selling for $9 each, so you spent $90 on buying 10 shares in Apple. As of October 2020, Apple shares sell for $115. So your 10 shares are now worth $1,150, despite the fact that you only paid $90 for them 10 years ago. Okay, so we've talked about what a share is and how you make money from them. And at this point, you've probably got a few questions like how much money you need to get started or how risky is buying shares in a company. And I promise we're gonna get to that. But point number 6 is how the hell do you buy a share in the first place? And this is where it can kind of get complicated because it's not as simple as going on apple.com/buy and just buying a share in Apple. It doesn't quite work like that. Instead, you have to go through what's called a broker. And back in the day, a stockbroker was a physical person, usually a dude, who you would call on the phone and say, hey, Bob, I want to place an order for some shares in Apple. And then Bob would type some stuff into his computer or place like a paper order, and then you would own shares in Apple. Thankfully, these days, we don't really have to talk to Bob because there's loads and loads of online brokers instead. And so you make an account on an online broker and then you can buy shares in a company through that. A bit annoyingly, every different country has their own different brokers that operate in that country because to be an online broker in a country, you have to abide by like a zillion different laws. And so in the UK, the system is different to the US, which is different to Canada and Germany and so on. In the UK, for example, most banks do have their own online brokery type thing. So with most bank accounts, you can also open an investment account with them and then invest online. But usually the interface is a bit clunky, it's a bit old fashioned. And so you're usually better off going with an online broker. In the UK, the two that I use are Charles Stanley Direct and Vanguard. But before we get ahead of ourselves and make an account on Vanguard or whatever, we need to understand a few more things. And so question number 7 is how the hell do I decide which shares to buy? And the easy answer to that is that you actually don't want to figure out which shares to buy. You do not want to buy individual shares. And I'm going to tell you a little bit more about that once I've had a haircut, so see you shortly. All right, so new hair. I've got my Invisalign braces on, so I'm going to sound a little bit different, but where were we? Oh yeah, we were talking about why it's not a good idea, generally speaking, to invest in individual stocks. And I'm going to do a video about this some other time, but essentially the issue with investing in individual stocks is it's kind of risky. Like, yes, if you invest in something like Apple, chances are it's going to be around 10 years from now. But historically, there have been quite a few companies that people were like, oh my God, this is amazing. This is the thing to invest in. And then that company went bust. So you're automatically exposing yourself to more risk if you are investing in individual stocks. Also, in general, like it's easy to say, hey, Amazon grew 10x in the last 10 years. Therefore, it's going to continue to do the same for the next 10 years. But that's trying to predict the future, and the past is no real indication of future performance. And so the advice that most people would give for beginners is that you should not invest in individual stocks, you should invest in index funds. And this is what Graham Stephan, one of my favorite YouTubers, also says as well. He says that index funds are the best, safest, and easiest long-term investment strategy for most people, which begs the question, point number 8, what the hell is an index fund? So there's basically two bits to understand here. There's the index bit and the fund bit. Let's start with the fund bit. And a fund is basically where investors will pool their money. So multiple investors would invest in the same fund. And then that fund would have a fund manager, and the fund manager decides which companies the fund is going to invest in. For example, let's say I were managing a fund and I called it Gringotts, and let's say 100 people from my audience decided to invest in my Gringotts fund. I, as the fund manager, can say, okay, the Gringotts fund, now that we have 100 people's money, let's say is 100 million, so everyone's invested 1 million each, I've now got 100 million. I'm gonna put 20% of that in Apple, 10% in Facebook, 10% in Amazon, 10% in Tesla, 10% in Netflix, 10% in Johnson & Johnson, all of that sort of stuff. And so you, the investor, don't have to worry about this because you trust me and my fund Gringotts to manage your money. And as the fund performs well, because the prices of these stocks and shares increases, you get the returns and I take a 1 or 2% management fee. So I make a load of money because I'm earning 1 or 2% off of this 100 million that I'm managing. And you're not worrying about having to pick stocks yourself. You trust me as a seasoned professional to do that for you. So that's what a fund is. Now, the index bit refers to a stock market index. And so a stock market index would, for example, be the FTSE 100, which is the 100 biggest companies in the UK, or the S&P 500, which is the 500 biggest companies in the US, or the NASDAQ, or the Dow. And these are all different indices of the stock market. And if we use the S&P 500, for example, these are the components of the S&P 500. So we said it's the 500 biggest companies in the US. So number one is Apple, and Apple makes up 6.5% of the S&P. Microsoft makes up 5.5, Amazon makes up 4.7, Facebook is 2.2, Alphabet, which is Google, makes 1.5 and 1.5, so about 3% of the total S&P 500. And essentially, we've got these 500 companies. If you go all the way down, Ralph Lauren is 496, but chances are you've not really heard of many of the other ones at the bottom of the list. But chances are you've heard of most of the companies towards the top of the list. So the S&P 500 is an index of the US stock market. And if you look at the performance as a whole of the S&P 500, you get a general idea of how the US economy is going as a whole. So this is currently what the S&P 500 looks like. And if we do a 5-year time horizon, in fact, let's go max. So you can see, the S&P 500 started in 1980. And since that time, this is what the US stock market has been doing. So, as you can see, there is a general trend upwards. But for example, in 2000, there was a bit of a crash. In 2008, famously, there was a bit of a crash. And earlier this year, when Corona was first starting to be a thing, there was a bit of a crash. But then the market basically immediately recovered after that. Okay, so we know what a fund is, i.e. a way of pooling money, and we know what an index is, like something like the S&P 500. When you combine those, you get an index fund, which is a fund that automatically invests in all of the companies in the index. And so with me, for example, basically all of my investments, all of my money is in the S&P 500, which effectively means that 6.5% of my investments are in Apple, 5.5 are in Microsoft, 4.7 in Amazon, 2.2 in Facebook, 3% in Google, 1.5 in Berkshire Hathaway, and so on. So why is this good? Well, it's good for a lot of reasons. So firstly, index funds are really, really easy to invest in. A big problem that beginners have to investing, it's like, well, how the hell do I know which company to invest in? How do I read a balance sheet? How do I do any of this stuff? If you invest in an index fund, you actually don't have to worry about any of that. Secondly, index funds give you a decent amount of diversification. There are all sorts of companies in the S&P 500, so you're not entirely reliant on the tech sector or the oil sector or the clothing sector or anything to make the bulk of your money. You are very nicely diversified across all these US companies. Thirdly, index funds have very low fees. So because it's not a real person who is deciding, what to invest in and doing all this research and trying to make loads of money, it's essentially a computer algorithm that automatically allocates your money, based on the components of the index fund. The fees for those are really low. And one of the main things about investing for the long term is that even a slight increase in your fees is going to massively impact your financial upside. And so, for example, an index fund with a 0.1% fee is so much better for you than an actively managed fund where a fund manager is charging you even 1%, because the long-term difference between 0.1% fees and 1% fees is sort of absolutely astronomical over the long term. And finally, if you look historically, and technically historical performance is not the